Do I want them to have to work for me to put my needs first? And the other thing that's very, very different here is in this world, this registered representative world, we're working on a commission basis, and they are recommending securities and they're executing transactions. I'm recommending. What does that mean? Who's making the decision about what to buy and sell in this model? The client is. The customer is. Okay, the theory is that the customer has as much knowledge as the registered representative. Now, is that likely to be true? No. So that's why I said I think this model is broken, and it's actually more people are using investment advisors than they used to, but it's still a lot of people are, there are still people interacting with this model, and there's still no fiduciary responsibility regulation on the horizon, which is what these people would like to see. They'd like to see everybody have to be a fiduciary, but that's not going to happen. In this case, an investment advisor is integrating the client's goals to their investments. So if you go to see an investment advisor, they're going to ask you to get naked. They're going to ask you what kind of assets you have, what are your liabilities, what are your cash flow needs. The registered representative doesn't need to know any of that. I had a client that referred their son to me. And I said, well, before we work together, there's some information I'll need to get from you. And he said, I don't want to tell you all that. That's personal. I said, well, you can't be a fiduciary to somebody that you can't be personal with. It's a personal relationship. You have to know more about. I have to know more about you. So this is our platform. We think it's a better platform, obviously. That's fine. But whatever your platform, I think it's important to know who you're dealing with to educate yourself about that. Captive. If you're captive, for example, a captive investment advisor works for one company, and an independent investment advisor, which is what we are, can work with we can custody assets anywhere. So we could custody assets at Schwab, Fidelity, and that's another thing that's important to remember. We're not too far from Bernie Madoff. We've had a few Ponzi schemes in Cincinnati, so there are those of us who insist that it is not too good to be true, that there are people who can make a guaranteed 10 or 12% a year. And, of course, those are the people who eventually lose their money. And one of the things that happens in those Ponzi schemes is these people are not investment advisors, but they're also not they're writing checks to the person that's helping them invest. People were writing checks to Bernie Madoff. When you're working with an investment advisor, you also have an independent custodian. The custodian holds your assets for you, and the investment advisor can see your account and can trade your account for you and can give you advice around your account, can do anything you need done, but the custodian holds your assets. It's your account. Just like if you open an account at the bank, it's your account. The investment advisor can just assist you with your account.
So you can't make withdrawals?
We suggest the investment advisor can send a check to your account anywhere you want. If you have but only if you authorize it. Okay, so like if you want to have a regular withdrawal, you actually can sign to do that, and then you can call up and say, send a check to here. But the check goes to your account. It goes from an account where you're custodying your assets to a bank account. But we couldn't send a check to Aunt Sue or to ourselves or to anybody else. And that's what the custodian in the picture does for you. It gives that independence of custody. And to me, that's such a common place, I forget to even mention it. But it's a place where people sometimes fall down on those Ponzi scheme pieces. So I'm going to close with a case study, a pretty dramatic case study. And it illustrates why I think it's important to start from the beginning, to start from the big picture. And this is a person I worked with just recently. Actually, it was this year. It was someone who was referred to me. There was these are the kind of the outline of the case was there was $7 million estate. There had been a death in the late last year, just as the market was beginning to tumble. There was a closely held business that was run by the person who passed away. So the person running the closely held business had died, and there was a spouse who really wasn't involved in the business that was left to run the business and to manage this estate, neither of which she had done before. There was an AB trust, which meant there was an estate planning attorney who had been engaged prior to the husband's death, and they had so the assets had gone into these trusts at his death. So we had we had assets that were held in his name, and then these assets transferred into a trust at his death. And there was no one had really talked specifically to the person about their goals, values, and intention. There was no comprehensive process for addressing the needs of this individual. They had a lot of advisors, though. They had an estate attorney. They had 2 CPAs, one for the business, one that was hired for the trust. The person hired for the trust was also valuing the business, which was necessary to file the estate tax return. We had one of the sons working in the business because, again, the person that had died was running the business, so the son stepped in and was interimly running the business, trying to decide what we were going to do with this business. And I keep forgetting to change the slide, Andy. We had a registered representative. We didn't have an investment advisor. So we had someone who was buying and selling transactions who was recommending to this person what to do. Now, in this particular case, you're recommending to someone who's never had responsibility for any of these assets before. So what are the chances that we're going to get a good result? Well, so we got involved. The first thing we did was what? We talked about what are your goals, what are your intentions, what are your values. We didn't talk about how do you invest, how do you do anything. We just started talking about what do you want to do in your life and looking at all the components, all the working parts, because there's a lot going on here, all the working parts. Right from the beginning, I was pretty confident that we'd overpaid our taxes. And sure enough, we'd paid about $1.5 million in taxes that we didn't need to pay because nobody had looked at the big picture. The CPA who was working with the closely held business wasn't so interested in understanding the trust or the estate tax. They were just looking at the closely held business, and this is what I do when I have a closely held business. And the CPA that was involved with the estate was saying, this is what I do with an estate. Well, these two things have everything to do with this individual's wealth. And there's some tax things that were opportunities, we call them opportunities, that were missed to the tune of $1.5 million. Now, I understand it's a $7 million estate, but still, $1.5 million on a $7 million estate, that's a lot of difference. Big difference. There's another $500,000. It could have been $2 million, but some decisions had been made early on that were irrevocable. We couldn't go back. So we'd lost $500,000, or that's our guess, of monies that just we'd helped reduce the federal deficit, which I'm sure we're all appreciative of. Okay, the portfolio that was here, we had a registered representative, so the survivor was making these decisions. Now you're a survivor, you've just lost a spouse, you've never been involved in investments. How likely is it that you're going to be making really clear decisions? So, and you've got a person over here that's a registered representative, not your fiduciary, who's recommending things to you. You know, it's just a bizarre relationship. But, of course, this person doesn't even understand who they've hired. The portfolio had 20% of its assets, 20% of its assets in one stock. Now, it wasn't a stock, actually, it was a bond, but in one company. So that meant if that one company went out of business, that 20% of their assets would be gone. I don't think that's a very good idea. I don't know about you, but I personally think if I had to change my life because one company in the United States went out of business, I wouldn't be really happy with my investment advisor. You might not either. The other thing that was true about this portfolio is it didn't provide for the cash flow needs of the survivor. It was inappropriately invested to meet her goals. I mean, it was a large amount of money. But what do we know about people who have large amounts of money? They tend to spend large amounts of money. So we have to invest and accordingly to meet those cash flow needs. And there was no coordination because the investment professional had nothing to do with the taxes, had nothing to do with the cash flow, was just looking at the investments. Bad decision. Also, there were a lot of people out there getting paid, and they're all getting paid by the hour. And they weren't really working together, and they weren't working smart. They were just all doing their thing and all sending bills. Future savings in this case was over $15 million. So what we know is that we can get to our goals faster, better, more efficiently, with a lot less work if we do it from the perspective of our whole life. You think about it. I just recently had a relative who was ill, and the most frustrating thing about his care during that time was his spouse kept saying, they treat him like he's different parts. Our body as a whole, our financial life as a whole. We have to treat the whole. So and if we treat the whole, we make our decisions within that whole, we're going to get a better result. So with that, I'll take your questions if you have any more that I haven't answered as we've gone along. Yes, yes, sir.
You got a few letters or something about asset allocation
Mm-hmm.
in the past. Why is that? Is there an explanation? Were they saying you need to be doing this?
You turned the 2 slides I didn't go over?
Well,
What
you were discussing asset allocation.
Mm-hmm.
You said you received a few things in your mailbox that asset allocation is.
Oh, there was actually a conference call recently. At Yale, I don't know if you've ever studied the Yale pension funds. If any of you, the asset allocation, because their portfolios went down. So what happened in asset allocation?